So what I'll talk about today is a doctor who's in the process of getting a whole life insurance policy right now, and the main reason he's getting it is to build the cash value up and then use it for his business. So before we get into his policy, because I'm going to go through the exact plan that he picked for himself, I'll start with where he started. When I had a call with him initially, this was a couple months ago, he let me know that he's had whole life insurance in the past and he has not had a good experience with it. He had a whole life insurance policy where he was set up where he just paid a premium, and it was really sold to him as a policy where if you just put money away for a long time, you'll have a lot of cash value. So he was paying about $2,500 per month. That comes out to $30,000 per year. And the policy he was sold was a policy where when he looked at the cash value, he saw nothing in the beginning. So the first year, the cash value was about zero. And as he continued to pay $2,500 per month every year, year in and year out, he would see that by the 10th year, it was actually a little bit longer than that, he would finally get his money back. So this would be his break-even point. So where we will start today is with exactly this. This, what I just described, is a perfect example of exactly what not to do if you are interested in a whole life insurance policy and you want high cash value. So he had a policy where he's paying $2,500 per month, $30K per year. Let's look at this policy. It's just a basic old school life insurance policy. And as we look at this, we'll see a lot of pages, but we'll scroll down to our number page. There we go. And his plan is to pay into it for about 15 years, at least in this example. The funding period is going to vary, as you'll see. So starting in this example at 44 years old, and this is just a basic old school whole life insurance policy. He's paying 30 grand per year. That's the annual premium. And we've got all of these columns, but here's what I wanted to focus on, because this is what he was interested in. And frankly, is what most people are interested in. The first year, he had just about nothing to show for it. He paid 30 grand. He had $1,000 in available cash value. What that means is if he cashes the policy out in the first year, he gets $1,000 back. He will have lost $29,000. Not attractive at all. Now the second year, he does get his 30 grand back, but he's got to make up for lost time. By the 10th year, he's paid a total of $300,000, and he still doesn't have $300,000. So let's take a look at this on Excel, and we're going to break down the policy. So he paid 30 grand per year, and it all went toward the premium. So 30 grand per year, the total outlay is going to tally up all of the years. Every year he makes a payment, his total out-of-pocket increases. As we continue to look at this, you'll see that the break-even point is between 13 and 14 years. So before he sees any gain on this, he's got to wait 12 to 13 years just to see a gain. Like, that's a long time. There's no possible way I would do this or recommend anyone do this if they're interested in a policy for the cash value. This is a perfect example of exactly what not to do, and frankly is where a lot of people feel ripped off when it comes to whole life insurance. This makes it very easy for people who are anti-whole life to attack this product and say, why would you ever do this? Like, look at the huge lost opportunity cost all of these years. So this is what not to do. He's paying in up until about 60 years old for 15 years, pays nothing after that, and long term, it does produce a return. He's got cash value and a death benefit, and usually when people are sold a policy like this, they're sold on the long-term benefits. Look at where you'll be when you retire, and you can access all of this money tax-free. That's why people get this. But did you know it can be a lot better? So let's look at the exact same product. Here's the cover page. Ready? I went to the next illustration. Cover page looks the same. Whole life 95. Let's go down to our number pages. And when we look at this, this is going to look similar. You see how much he's paying each year? 30 grand per year. But look at your money column. Cash value. It's a lot different, isn't it? Way different in the first year. You've got almost $26,000. Here's the difference. We're paying in $30,000 per year, but it's not all going toward the insurance premium. This is the key right here. This is how we get a policy to produce as much cash value as possible. Of the $30,000, we have $3,000 going toward what is called our insurance premium. Then we have $27,000 here, but of that 27, about $500 goes toward what is called a term insurance rider. It prevents a taxable event from occurring, but our minimum is about $3,500. The rest is going toward this paid up additions rider, this PUA rider, which I like to refer to as a cash dump-in. And this is the exact same product with the exact same insurance company, the exact same health rating. All we're doing is putting less money toward the insurance premium and more money toward this rider. And again, we can call it a cash dump-in to keep it simple. Let's look at them side by side. So we looked at what not to do. Here's what I would do. Same out-of-pocket to him, $30K per year. The difference is the breakdown as to where the money is going. There's his cash value, just about getting everything back by year 4. Year 5, he's positive. There's our death benefit. Ready for the fun column? With the exact same product and exact same company, again, same product and same company, look at the difference in the first year and all years after that. This is showing how much more you have in cash value if this is your policy by having it set up differently. This is the importance of having the policy designed correctly or set up correctly if your goal is cash value. So the first thing that we talked about when he brought up the fact that he had a life insurance policy and he had 0 in the first year and it took forever to get his money back, he did not want that again. Because the policy he's looking at now, he's planning on paying in $250,000 per year. That's not the death benefit in the policy. That's how much he's going to fund it with, $250,000 per year. So is there any way that you would do what we covered above, where instead of paying $2,500 per month, you're going to pay $250,000 per year and have nothing to show for it? Like, no, that would not make sense. Why he's getting this product, why he wants to put in $250,000 is mainly for the cash value. There's a couple reasons here, or a few reasons. I like to refer to them as the core benefits. Safety. The money grows without any stock market risk, regardless of what happens in the economy and the stock market. His net growth rate is probably going to fall somewhere between 4 and 5% over time. He can access the money, and there's a unique loan feature where if he borrows against it, he continues to earn dividends and interest on his entire balance. So think of it this way. If he's got cash value of $100,000, and he decides to take a loan for $50,000, if that cash value is earning, let's call it 4%, if he doesn't touch it, he borrows 50 grand, There is a cost to borrow. Let's say that that's 5%. He pays that to the insurance company. That'd be $2,500. 5% of 50 grand. However, here's why people do this. He still gets 4% on the full $100,000. So 4% of 100,000 is 4,000. So he's got a positive spread in this particular example of $1,500. Now it's possible to have a negative spread, and we just want to make sure we look at the numbers each year so we've got transparency there. But regarding the loan feature and accessing the money, he can access the money anytime, and he knows when he accesses it, his entire cash balance stays at work for him. So his idea with using this for his business is he views it like this. I can get a big bucket of cash value here. I know this is always compounding for me, so I can use it for my business while the money stays at work. I do have a cost to borrow, but I'm okay with that because it is a cost for my business. So there's a potential tax deduction there. If we do everything right, we've got to be careful with the IRS rules around life insurance and loan interest, but we've seen CPAs deduct the loan interest as long as we document everything properly. But he can use it for his business. And what he really likes is once that dollar amount gets big enough, he'll use this instead of having to go to banks. Because with life insurance loans, he's in full control of how he pays it back, when he pays it back. It's extremely flexible. I just access the money through my online portal. He likes it a lot. So that's the second reason, accessing the money. And then the third is if we do everything right and follow the IRS guidelines, I can use the money completely tax-free. Which for a doctor in a high tax bracket, if I'm earning 4% without any market risk, and I've got the tax-free benefit, that's extremely appealing. Because I might be able to get 6 or 7% somewhere else, but if I have to pay taxes on it, that's going to drag the net return down. So this is another reason why he likes putting money in life insurance. And again, he's mainly viewing it like a line of credit for his business. So let's look at his actual policy. Actually, before we do that, something really important here. He had questions about the policy, particularly with the tax treatment. Because I said, if we do everything right, you can access that cash value completely tax-free. When I say if we do everything right, I'm referring to the agent setting it up right and making you aware of things that can trigger a taxable event. Naturally, he had questions. And if someone doesn't ask questions about this, and we're working with them, what I'll make it a point to do is ask questions for them because this is important and I want to be made fully aware of how to prevent a taxable event. So, money you pay into the policy, we'll call this payments. Some people like to call this deposits or funding. This is you paying money to the insurance company. Dollars you pay are after tax, meaning we cannot deduct the payments we make, even if the business owns the policy. So we can't run it through the business as an expense. The reason why is because we are building cash value. That's a cash asset, which we can use. It is possible to deduct the full payments with a life insurance policy. However, this is a big however, we can only do that if the policy is opened within a qualified plan, like a 401k or an IRA, and then we give up access to the cash value. I should say we give up easy access to the cash value. So most people don't do that, and usually we see them set up as a traditional policy, which I'm funding it with after-tax dollars. The growth is technically tax deferred if I were to look at the IRS definition. And then, like we mentioned above, we can access it completely tax-free. So here's a couple things to be aware of regarding the access. it's possible to mess it up. So how I can mess up, can tell I was not an art major. One, if you have a policy, you cash it out, and there's a gain. That would mean there's more money in cash value than what you paid into the policy. You paid in $100,000, it's worth $150,000, so you pay $100,000. It has a value of $150,000. You cash it out, the gain would be what? Everything above what you paid. That'd be $50,000. So that means you would have to pay ordinary income tax on $50,000. So if you earned $100,000 in income that year, that's what you're taxed on, you're going to have another $50,000 in income tax that's due. So if we do cash out a policy, we do want to be aware that the gains will be taxable. Number two, if a policy lapses with a gain, and this is usually due to a large outstanding loan. This is rare, but it is possible. We've seen and heard it happening more with universal life than it does with whole life, so two different types of products. But if a policy does lapse with an outstanding loan, the IRS is going to look at the policy and say, how much money did you pay in? How much did you take out in loans? How much is there in unpaid loan interest? And then they're going to calculate the total gain. We've got other videos where we can provide more information on that, but that can result in a large future tax bill, which we definitely do not want. But again, that's rare as long as we don't abuse the policy and loan out every penny and never pay anything again into it. It usually doesn't happen. And then number three, most people are familiar with this, is if we trigger what is called a modified endowment contract, which means MEC. So if your policy becomes a MEC, what happens then is the cash value still grows tax deferred, but anything you access at any point in time, even if you don't cash it out or lapse it, you have to pay income tax on the gains. So it's not capital gains tax, it's income tax. And then if you're under the age of 59 and a half, you've got that 10% penalty tax rule, which no one wants. He's starting at 44 years old. So this would apply to him if his policy becomes a MEC. Now, the good news about that, it's very easy to prevent this. And even if it happens, you've got 30 days to reverse it, and we're notified the next day. Meaning if you trigger a MEC by accident, we're notified the next day by the insurance company, and it's very easy to reverse. But before that would even happen, when we set up a policy, every policy has what is called a MEC limit, which is exactly what it sounds like. It's a limit that determines the maximum dollar amount the IRS will let you pay into a life insurance policy on any given year without a MEC occurring. So how that limit is determined, the IRS has a formula for this, but the two main things they look at are your age and the total amount of life insurance. This is called the death benefit. The benefit that is paid out upon your death with the insurance policy that you're getting. There's more to it. Different products will have different MEC limits, but for this gentleman who is starting his policy at the young age of 44, he wants to pay in $250,000. In order to get a MEC limit of $250K, how much life insurance does he need? Well, he needs a total death benefit of $5 million. That gives him a MEC limit of 250. If that seems confusing, your agent can always calculate that for you. And how it's done, they just run it through the software with the insurance company that they're showing you the illustration with. It's through the quoting software, and these policies are always MEC tested through the software. It's very easy to prevent a MEC from occurring. But anyway, that's how we would calculate the MEC limit. I hope that makes sense. If you'd like a more technical explanation, let me know. Always happy to go into detail. So let's look at his plan. His overall plan, we said he wanted to pay $250,000 per year. So what he wants to do, he's 44 now. He doesn't want to fund the policy anymore when he turns 50 years old. So that $250K per year, he wants to do that for the next 6 years. You'll see that'll take him through the age of 49. And $250,000 times 6 years means he will have deposited a total of $1.5 million. Question he has here, and that a lot of people have. If that's my plan, do I have to pay that? If life happens and I can't get that much money into the policy, am I required to do that? No. Not at all. It's also set up to be extremely flexible. So, remember the example of what not to do versus what to do? Where we had what not to do. Let me pull it up actually. Remember this? So this was based on $30K per year. What do you notice in the example that says do this? What's different about it? Give you a hint. There's 2 extra columns, and they're in purple and blue. Purple column, that's the big one. 27,000, and the other difference is what's in blue, 30K. This is actually the same thing as this because you're paying 30K per year. However, with the do this example, your minimum premium is 3K. It's at 10% of the total payment, which when we look at your top life insurance companies, your 4 major mutuals, typically we can drive that minimum premium to about 10%. I want to drive it as low as I can because that's what allows me to minimize cost and then maximize cash value. So here's what he wants to do. Here's his policy. Do this. $250K per year. What's his minimum? Just like that $30K per year example. Minimum premium, $25K per year. Here's the PUA payment. Now, is he committed to the PUA? No, he is not. This is optional and very flexible. He can throw this in whenever he wants. How he does this transactionally is by logging onto his online portal and just adding extra funds. And it could be every week, every month. It's extremely flexible there. Assuming he gets the full target amount in, it's $250 per year. Look at that cash value grow. First year, there's a loss there of about 30 grand. That's the biggest drawback. He asked, why would I not do this? Like, what's the biggest drawback? Looking at the numbers, I like to point this out. It's the first year. Even when we minimize that premium as much as we can based on the insurance company limits and when we run it through the software, like as low as we can push it, that's the hard part because that is taking the biggest bite out of your cash value in the first year. Now you do make up for it, but that first year hit takes between 3 to 4 years to make up. That's why people typically would not do that. In his case, especially since his first policy, he paid in 30 grand and had nothing to show for it. Now this is 250 and he only takes that 30 grand hit. It's like, all right, that doesn't bother me that much. especially when I see the long-term benefit. So he was okay with it. But you've got to make that very, very clear, just so we're not assuming someone's comfortable with it. After year 6, when he's 50 years old, he can keep funding it if he wants. However, he wants to stop there, and a big reason why is he wants to use this for his business. And when he's using it for his business, any excess cash flow, he wants to be able to use to pay back money he uses, so specifically through loans. Let's wrap up with this point. So if we look at our loan workbook here, remember where we talked about you still earn interest on the money you borrow? This is going to demonstrate this. So here's the policy. By age 60, you've got $2.5 million in cash value. If you let it sit and grow, I've got $2.5 million. If you borrow against it, pay it back, borrow again, then pay it back, and it's paid in full by age 60, we'll see $2.5 million. Now, depending on the company, and if you hear a term like direct recognition, it might be a little bit different, but that's not going to make a big difference when you look at the net numbers at the end of the day, factoring in the loan interest and everything. You will see you continue to earn dividends and interest on everything when you take policy loans. So, here we go. I forgot to mention before, we do reduce the death benefit in year 8. The reason why is because we are reducing the insurance expenses. Let me show you on this. So here's the $250 per year example. Year 7, the death benefit's $5 million. Year 8, you'll notice the premium's gone. This guy, which is term insurance we have attached to the policy, is gone. We are reducing the expenses as much as we can. And the reason why is because he does not want to pay anything starting at age 50 into the premium or PUA. He just wants to watch it grow and use it for his business. So when I don't want to pay anything anymore, I'll kill that premium, which is optional. We don't do this when we start a policy. This is done after the fact, so he can change his mind. But when we eliminate it, it does drop the death benefit, but it allows our cash value to grow at a faster pace. That's the main reason why he's interested in that. But I just want to highlight that, and you'll see why. So LTV, loan to value, 95% of cash value. This column shows how much you can borrow against your policy. So you can take a loan anytime. It can be 10 business days after you start it, no problem. Let's say, for the sake of simplicity, it takes a $1 million loan at the 5th year. Your cash value was 1.2. Now it's just $236,000. The interest rate is the fixed loan interest rate on his product. It actually drops to 3.5%. Actually a little bit lower than that at year 21. That's specific to the company he's looking at. But what this illustrates is a $1 million loan. There's your loan balance. 4.76 shows the interest over here. Now, paying the loan and loan interest is optional. In this example, he plans on doing it. So there's the loan interest, $47,600. That's what he's paying. Here's what most business owners, and we see this a lot with real estate investors too, ask. What is my money growing by? What am I getting from the insurance company? And what am I paying them? So the first year he takes out a loan, he's earned $37,000 total that year, and he paid $47,000 in change. It's a net cost of about 10 grand. The next year, the net cash value growth, $50K, cost $47,600. He's positive about $3,000 in this example. And it gets better and better from that point forward. So the purpose of this, and the insurance company usually does not provide a side-by-side. This is just something we like to do because it helps me, honestly, when I can look at the numbers and say, okay, does it actually make sense? Like when I look at the dollars that I get compared to the dollars that I pay, am I actually getting more than what I'm paying? And if I'm not, that's okay. I just want to see that up front so I don't feel like I'm getting a 6% dividend and I've got a 5% cost to borrow. Like, that can just be confusing for people. Because what happens if you take a loan up here? Look at the interest compared to the growth. This is where the dollars help a lot of people. So going back to this example, you've got your $1 million loan. Let's assume he pays nothing except for the interest in year 6. And then at age 50, he's not funding the policy. So he's going to begin to repay the loan. He's paying interest every year. So the payments we put in here are going to attack the principal balance. I forgot something very important. When you take that $1 million loan, look at your death benefit. Before, after. Death benefit is always collateralized dollar for dollar. So let's begin to repay it. Let's pretend we throw $100K per year at the loan. Two years too short. All right. So loan is paid back, and we see each year how much we paid in loan interest, along with how much we got. Sometimes what we'll do is create an extra column that shows the total gains compared to the total interest paid. Some people like to see that. Most, I have found, prefer just to see what it looks like on a yearly basis. But we'll always help someone with whatever they want to see. And if you're watching this video and you already have an agent that you work with, they can likely do this. They'll have to run the illustration and try and lay it out side by side. But it's possible. Like all of this stuff, like how we built it, it's all based on the illustrations that we run with the insurance carriers when we put these policies together. Really, like all of this, it's just a tool that is meant to simplify things or make it a bit more transparent. I don't know that you would call this simple when you see a million Excel columns, but to make it simple, like a lot of times what I'll do is something like this. Watch. I hope this helps. If you said, okay, just show me the bottom line here, Steve, like stop making this so complex, I would say, okay, I appreciate your feedback. Here is what I would do. Ready? Is that better? So I can just see exactly what the earnings were versus the cost. My point is, they're tools that are meant to help simplify things. So in his case, he's putting a lot of money into a life insurance policy because of the safety, the fact that he can access the money, and also the tax benefits. We went over the tax treatment regarding payments going in, always done with after-tax dollars. The growth, per the IRS definition, is tax deferred. And the reason why is because I'll have to pay taxes if I cash it out or if I trigger a taxable event. But if we follow the IRS rules, I can access the money tax-free. I just want to make sure that I, or me, the agent, or whoever your agent is, does not mess it up, because that turns this initial reaction into this initial reaction where we're not happy. I forgot to get his nose on there. Anyway, that's why he wants to use the policy, or that's why he wants a life insurance policy. The loan feature that we went over is very attractive to him, and that's why he's doing this. I do hope that you enjoyed this video. I would love to hear if you have any thoughts. Feel free to leave any questions or comments below. And as always, I hope this helps. Thanks so much for watching all the way through.